Ladies and gentlemen, good day and welcome to the Ramkrishna Forgings Q2 FY26 earnings conference call hosted by IIFL Capital Service Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Joseph George from IIFL Capital Service Limited. Thank you, and over to you, sir.
Thank you, Muskan. Hello, everyone. On behalf of IIFL Capital, I welcome you all to the 2Q FY26 results conference call of Ramkrishna Forgings. I also welcome the senior management of Ramkrishna Forgings. We have with us Mr. Naresh Jalan, Managing Director, Mr. Chaitanya Jalan, Whole-Time Director, Mr. Lalit Khaitan, Whole-Time Director and CFO, Mr. Milesh Gandhi, Whole-Time Director, Mr. Rajesh Mundra, VP Finance and Company Secretary. Now I'll hand over the call to the management to take the call forward. Over to you, sir.
Thank you, Joseph. Good evening, everyone, and thank you for joining us on this call to discuss the Q2 and H1 FY26 earnings. In Q2, we continue to operate in a challenging global environment. Geopolitical tensions and shifting trade alignments disrupted supply chains, while currency volatility and higher input costs added pressure on margins. Across key international markets, OEMs and customers adopted a cautious stance, moderating order volumes and rationalizing inventories. Collectively, these factors created a difficult backdrop for the global manufacturing and automotive sectors, affecting both volumes and pricing across geographies. Our international business also felt the impact of this tariff and duty on exports from India, along with reciprocal tariff imposed by the US on other countries. And that has effect of raising the final retail price for end consumers, which in turn has had a bearing on buying decisions. Thus, sales velocity has been subdued for our international OEMs customers. In contrast, the domestic environment proved more supportive. Strong macro fundamentals such as steady industrial output, resilient IIP growth, moderating inflation, and softer interest rates have contributed to healthier business climate. The government's recent GST rationalization provided an additional boost, helping revive customer sentiment in automotive sector after a period of subdued demand. Lower tax reduced on-road prices across vehicle categories. In recent years, we pursued a strategic imperative to strengthen and diversify our domestic presence through focused investments and product innovations, particularly in railway and passenger vehicle segment. Domestic business is picking up with good timing, given the challenges in global business, and these efforts are now yielding results. The railway segment is gaining healthy traction, with our products being integrated into the bogie assemblies. Our newly launched vertical supplying castings to railways has made a promising start and is well positioned to scale up meaningfully in the coming quarters. Looking ahead, our priorities include the introduction of new product, optimization of capacity utilization, and further diversification of our revenue base. Now let me share some financial highlights for the second quarter. For Q2 FY26, we reported a consolidated revenue of rupees 907.53 crore, that is lower by 10.6% on quarter-on-quarter basis compared to 1,015 crore. The top line was constrained by subdued demand and tariff on exports, which impacted revenues from international customers. EBITDA excluding other income is rupees 122.54 crore in Q2, lower by 17.5% quarter compared to 148.61 crore in Q1 FY26. EBITDA margin stood at 13.5%, lower by 110 basis points from the previous quarter. Profit after tax is negative. We have incurred a loss on Concall basis of 9.5 crore in Q2 FY26. In the current quarter, this above loss basically is due to the few factors. One is the forex loss incurred by the company on import of equipments, that is amounting to 6.77 crore, and impact of tariff is 10.75 crore, which we have to account for in terms of the settlement with the customers. Loss of 3 crore we have incurred on account of operations in Mexico operations, and a loss of 4.84 crore has been from the JV again on account of forex loss on import of equipment. Cumulative, the above impact is about 25.26 crore on the overall profitability of the quarter. Otherwise, this quarter we could have posted much better result. A few more highlights in this quarter. In August 25, the board approved allotment of 9,75,000 warrants to the promoter entity pursuant to the promised fund infusion, and an amount of rupees 51.19 crore of 25% of the issuance amount has been paid upfront, and balance will be paid before March 26. The board has approved another proposal today to issue 34 lakh share warrants at a price of rupees 588 per share, and total amount being 199.92 crore to Mr. Chaitanya Jalan, our promoter. Further amalgamation proceeding of Multitech Auto, the step-down subsidiary, and Mal Metallic with the Ramkrishna Casting Solution Limited is progressing well, and we expect the order from NCLT in the Q3 FY26. So that's on the update from my side. Now I hand over the proceeding to Mr. Milesh, full-time director, to update you on the market. Over to you, Milesh.
Thank you, Lalit. I would like to brief the fraternity here with during the Q2, the company secured new orders worth 1,116 crores with a program life of 4 years, excluding the railway segment. Out of this 1,116 crore order wins, 69% came from the automotive sector worth 777 crores, 27% came from the railway segment, that is 296 crores, and 4% came from non-auto, that is around 43 crores. This reflects our continued progress in our company's diversification strategy. Excluding railways, all orders wins were from international geographies. This is worth mentioning. And we would also like to state that for Indian Railways, the company received orders for the fully finished assembled bogie frames. And with the required approvals now in place, the bulk dispatches have already commenced. Apart from this, we have also received a very strong demand in castings for the railways, and we have bagged order worth 200 crores for the same. That's from my side. Thank you.
Thank you, Milesh. So that's all from the management side, and now the house can be open for the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Siddharth Basi from SASS. Please go ahead.
Hi, good evening. Thank you for the opportunity. I will ask a few questions, and I'd like it if you could answer them one by one, so that will be great. Firstly, regarding the drop in revenue and the drop in EBITDA margin, in the last Concall, the management had told us that from Q1 onwards, Q2, Q3, Q4 will be looking progressively better, where there will be an expansion in margins and a growth in revenue. So what made the revenue drop and the margins reduce? Because in the last call, you had also mentioned that the impact of tariffs was only 6 crores on a US customer. So that's nothing compared to our top line. So management now saying that the tariffs have led to a reduction in revenue does seem a little off from the last call. So could you just explain the disparity, please, and then I'll ask the other questions.
So that actually, assuming that in the first quarter of the year, the tariff was only 25%, and post-reciprocal tariff of 25%, the tariff went up to 50%. And there was a lot of confusion until mid of September when the government of US has clarified that automotive tariff is only going to be 25%. And that led to slowdown of dispatches from for the customers in terms of asking, because they were not prepared to pass on any tariff beyond 25%, which had been agreed by them initially. Second is that overall, it is tariff-related activity has just not affected North America, US. It has affected our Mexico also, because overall demand in US has gone down drastically beyond the projections which were received from customers. And we, on a rational approach, we did not want to continue shipping material and parking them in the warehouse and affecting our cash flows. That's the reason, as a rational company, took a step to cut down on the inventory, because if you see the right now projections which the customers or any US is coming out, that from first quarter of their calendar year, the situation is going to improve over there in US. And that's the reason we took a stand. And after all this clarification came, we have seen, and again, the pullback in terms of shipments have started happening.
Okay. So, sir, thank you for that. So, you're saying basically that post Q1, so Jan, Feb, March onwards, you're going to see traction in the US market. When now, obviously, since we're already halfway through the middle of Q3 as well, what sort of traction are you seeing in Q3? Is it significantly better than Q2?
Obviously, it is significantly better than Q2.
Okay, wonderful. So, are we then on towards Q3, Q4 guiding for higher revenues and higher margins, like EBITDA margins upwards of the high, like 18, 19 sorts, or what are we looking at?
In terms of revenue, we still maintain that with the kind of capacity we have already put in place and capacity up and running, and as promised that most of our capex will be completed by 30th September and capacity in place, we still believe that the projections which we had given at the year-end results, means at the March-end results of double-digit growth, we still maintain that on the full-year basis, we will be able to maintain our commentary of a double-digit growth for the full year.
With the higher EBITDA margins and the 15-16% range?
I think
so back to profitability.
We are back to proper stability.
To
your question only, I can very confidently say, with half of the quarter gone by, we can confidently say now that I think worst is behind us.
Right. So one question more. We've been plagued with a lot of one-time losses in the last quarter. Last quarter, there was fluctuation in steel prices and revenue loss on equipment coming in. This quarter also, we've now seen these one-time losses in terms of equipment, etc. So, sir, can we now finally put a close to all these one-time losses from next quarter? Or are we still expecting some of these to continue?
I think currency is not in our control, Siddharth. If 88.63 tomorrow moves to 91 or 90 plus, we are basically helpless in terms of managing currency. It is a global event, and currency, if it goes down or goes up, I think we cannot control. And these are all notional losses. Basically, this has to be provided in the books. These equipments, which are like for JV or other things, still the equipments have not been put to use and they are not generating any revenue. But as per accounting standards, we will need to provide for this. So, but that's the bottom line, how the accounting standards are maintained.
So, what I mean to say is, have we bought all the equipment that we needed to, so that there is no further transaction of that equipment taking place because CapEx is done?
No, CapEx is done, the equipment. Till the equipment is put to use, any currency which is being fluctuating, like for standalone side, I can confidently say that we are not importing any more equipment, all CapEx have been through. But the hit in terms of the JV which has come, our wheel plant is going to start, as per our presentation also, you must have seen that it is going to start from, we are confident to start operations from March 26 onwards, and trial runs to start from January onwards. So post that only we can confidently say that any more hit is not going to come into the books. But till then, obviously, till the work in progress is there, we will need to continue to take that hit.
Right. So since you guided that already through middle of Q3, we are certainly profitable, like you mentioned. Any hazarding a guess on the EBITDA margins, if that's possible for you?
No,
So
I think we
secondly,
cannot. I can only tell you we are back to normal, and I think we are going to third and fourth quarter is going to be extremely surprising and extremely on the upside of the results.
Wonderful. Sir, a couple of questions in terms of the pledging of shares. So the promoter basically pledged 200 crores with Tata Capital. Friends of mine at Geo told me that there was also also a conversation at Geo Finance for pledging shares to take money. So what was the money used for, or is being used for?
No, we have not pledged any shares to Geo Finance. We have only pledged to Tata Capital. That is basically to fill up the warrants.
To fill up the warrants. So the initial 2,100 rupee warrants, or these ones which Chaitanya is getting right now?
Initial 2,100 rupees warrants. 50 crores have been already paid, and balance, like Lalit has said in his opening statement, before the year end, we have pledged the shares at one time. We do not want to continue on daily basis, but the full amount has been secured, and payment will be made before March.
Okay. So just one last question from my end now. So because of the inventory issue that we have, and the management has done a great job in sorting that out, but sir, are our bankers or anyone else concerned in terms of giving us working capital lines or in funding our inventory, or we are not facing any financial challenges?
No, we have not faced any funding challenges or any institutional issues from our bankers.
Okay. Just to clarify, Siddharth, we are having a 700 to 800 crore lines available in my balance sheet as on date.
Okay. Right. Wonderful. Thank you so much, sir. Thank you for the opportunity, and I really hope that Q3 and Q4 really do bring out dividends for yourself and the shareholders.
I think your hope, we are extremely confident that we will come good on this.
Wonderful, sir. That calls for celebration next time we speak on call next quarter.
Yes.
Thank you, sir.
Thank you. The next question is from the line of Sunny from MK Ventures. Please go ahead.
Yeah, thanks for taking my question. My first question is on the debt levels. So debt levels have substantially shot up as on September 25th to, I think, more than 2,500 crores. So can you give some color on what has led to this sharp increase in the debt?
Sunny, I will answer this because you can see that the profit has been muted, so there are no cash accrual happened in the first 6 months. And the debt has almost gone up by 600 crore in the 6 months. That is mainly on account of the capex program companies incurred about 400 crore, and you can see 200 crore reduction on account of creditors of the company. So that has led to this level, but that level is going to sharply recover in H2 with the promoters infusing money, 150 crore coming back from the income tax, and certainly the operating leverage improving on account of improved sales and profitability.
Sure. So as per the cash flow statement, the consolidated capex for H1 was about 485 crores. So for the full year FY26, what is likely to be the level of capex outflow? So basically, what's the incremental outflow in H2? And by March 26, what is the likely debt levels that we should see from the current, say, 2,550 crores of gross debt?
So, Sunny, 500 to 600 crore reduction we should expect by March 26 from here.
And this includes the contribution from the warrant money from the promoter?
Everything 500 to 600 should go down till March 26.
Sunny, but one thing also you will need to note that this 2,500 crores debt includes the bill discounting for Tata Motors, and with the volume going up, we are factored in the increased sales within Tata Motors, which is basically not our liability, but still we have to put this as a gross debt, because ultimately that is to recourse to RKFL, but basically it is on the lines of Tata Motors and is being financed by Tata Finance only, and that is cumulatively that adds close to 100-150 crores roughly to the debt.
Got it. But that amount is likely to remain constant or?
Yes. No, that line is constant.
In terms
So
of the
basically, Lalit wants to say that 2,400 crores is basically leaving aside that we are close to 2,400 crores of debt, and likely 600 crores of debt will be reduced by this year end, financial year end. So basically, leaving aside Tata Motors, which is a line which is going to ever continue, we will be somewhere around debt of 1,750 to 1,800 crores.
Got it. And in terms of the capex amount, what is the further outflow in H2 FY26?
Sunny, I think we have already completed our capex plan, little bit on the maintenance capex side and little bit on the completion of the facility we are commencing. So it should be less than 100 crore.
And going forward, like now we are at almost 400,000 tons of capacity. And utilization levels are reasonably low. So we have substantial leeway to grow. So what should be the outlook in terms of capex for FY27?
Next year, capex will be negligible, less than 100 crores of capex, and next year utilization will move to close to around 85%, close to around. And I would be glad to tell you the casting facility, which is going to be entire 45,000 tons of capacity, which we have installed and is going to be up by end of this quarter. The entire capacity of 45,000 tons is almost sold out in terms of overall capacity. So we are going to have an entire utilization of this capacity to the tune of 80-85% next year, in a mix of railways and domestic and exports. And railway has, like Milesh in his opening statement has said, that in castings we have got a huge traction from Indian Railways, and this huge traction will lead to very high utilization in terms of the casting capacity and realization improving drastically from our casting facility.
Got it. That is very helpful. And sir, one last question from my side. In terms of your guidance for H2, while we understand some of these new capacities will ramp up substantially, what is the assumption that you are making on the underlying markets? Are you expecting them to basically bounce back sharply or remain at the H1 levels? Because that will also kind of determine what kind of revenue and growth you are able to achieve in the second half of the year.
I think domestic market has really bounced back very sharply post GST cut. And with the projections, whatever we have till March right now, it is showing a very good traction, and I think we will be able to do much better than what market overall grows in terms of with the capacity and with the kind of share of business we have been able to gain. And that is already showing in our Q2 numbers also in terms of our domestic growth. And in terms of exports, US has started. And within US, the new customer wins. I think in the presentation also we have elaborated that new customer order wins. We have been able to convince customer. Our marketing has done a good job, and we have been able to pull ahead the timings in terms of offtakes. And we have already started shipping material from this quarter onwards for several of our new order books for North America and oil and gas within North America. So all this taken together, we expect, and we are very, very hopeful with half of the quarter already gone by. This quarter and the coming quarter, we should be doing extremely well in terms of achieving our top line numbers and achieving a full year guidance growth, which we had given initially.
Got it, sir. Thank you. Thanks for the elaborate answers and all the best for the future.
Thank you. The next question is from the line of Mitul Shah from DAM Capital. Please go ahead.
Thank you for the opportunity. Sir, first question is on margin side. Sir, if I look at your presentation, utilization Q-on-Q has dropped from 69 to 60%. So drop is not very big. So margin contraction seems to be slightly beyond operating leverage. So is there any pricing pressure also?
Mitul, I think Lalit in the previous question has already answered. Margins, almost 25 crores hit has been come due to just a notional forex loss which we had to book in terms of our imports in equipment. And in terms of exports, there is no margin hit, but basically lower exports has affected our margin.
Sir, and then second question is on these order wins. These other orders we have indicated about 4 to 5 years lifespan, but this railway, so this 200 as well as 96 railway and 200 from the railway casting, are these executable in next 1.5 year, or
these are all annualized orders? No, these are all annualized orders.
Okay. And lastly, on the railway project, sir, we are about to start the operation in March 26. So, what is further update or any trial runs or anything is likely to start soon in next 1 or 2 months, or March 26 will start with the trial runs initially and commercial production will start somewhere middle of 27.
January we are starting trial runs, and we expect and we hope that from March onwards we start commercial production.
So lastly on this, considering this current global scenario and US related challenges, what would be our long-term strategy to diversify this on the non-US export side in terms of the client addition or geography addition?
Milesh, I would want you to answer this question.
I would like to state that currently we are already, as you see in this quarter, whatever we have won on the order wins, this has all come from the outside the international geographies. So this showcases one thing is that we are having a lot of traction from the international market, and at the same time, we are already not only securing orders in North America, but we have also secured orders from European market. You would also, if you go with the H1 total order wins, you would have noticed one thing, that with regard to Europe itself, we have already bagged a lot of orders to this time and taking into Q1, I think 927 crores worth of orders have come from Europe itself. And at the same time, in North America, like 307 crores came from the PV segment. So this showcases that the company is working on the diversification strategy, and currently we have been able to bag good orders. And as Mr. Jalan already stated, that we have been also able to work in this period wherein we have been able to develop the samples and PPAP lots and all faster, so that we can go for a faster launch, as this being a alternative purchasing proposals which we have received from customers. I hope I have answered.
Yes, sir. Understood, sir. Thanks and all the best.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Joseph George from IIFL Capital. Please go ahead.
All right, thank you. So, one clarification, you mentioned that about 25 crores of one-off impacts because of FX and Mexico losses, etc., were there in the quarter. I want to understand how much of this 25 crores is in standalone and above EBITDA.
So Joseph, if you look at this 4.82 crore of JV is certainly in the console, and 3 crore Mexico is also in console account. With the loss on account of tariff on account of forex of 6.7 crore is in the standalone, and that is in EBITDA.
Understood. So effectively, you're saying approximately 16 to 17 crores is above EBITDA.
Standalone EBITDA, yes.
16, 17 crores. Okay, understood. So that was one. The second thing I wanted to understand was, we have this 25,000 coal forging capacity, which was supposed to be 70%, booked by one OEM customer. Similarly, there's the aluminum forging capacity, which is also booked by a firm order. What is the status of these two capacities and the underlying orders, and which should we expect revenue generation?
Coal forging already has started revenue generation, and I think we are almost at 40% utilization right now. There are bugs which we are trying to settle down, and I think we are expecting next quarter close to around 60% plus utilization, and going into FY27 go to around 80-85% utilization. in the cold forging side, which will be, I think, the peak utilization. In terms of aluminum forging, our samples, PPAP, and everything has been accepted. And from this month onwards, means current month onwards, bulk shipments have already started. And I think we expect the utilization to go to 85%, close to around March or April of next year.
Understood. The last question that I had was, if you look at the order flow announcements in the last, say, 5 or 6 quarters, I'm just reading out some of the numbers. I'm sure you know them. So in 1Q FY25, there was a 1,680 crore new order flow. In 2Q FY25, it was 1,500. In 3Q, it was about 700. And now in the first half, it is 1,700-1,800. So overall, in the last 6 quarters, you've received new orders of from 6 to 7,000 crores. I want to understand, when will these orders start generating revenues in aggregate? I don't want to get into individual orders.
I think Joseph, there are parts of orders in this which are based out of Europe. They are going to start in phases from next year onwards. And I think if you consolidately tell me of the entire order book, you will be able to see the entire order book getting into production from FY28 onwards. But already part of the order book has started from this quarter, and that's the reason we are extremely confident to meet our exports sales of whatever we did in previous, in spite of market being on the slowdown. And in going forward from Europe and other places, we are looking at starting sales from first quarter of FY27, and almost by last quarter to reach 100% of this order book getting into sales.
So would it be safe to assume that on all these orders aggregating to somewhere between 6,000 to 7,000 crores, say in FY28, we will have an annual revenue generation of, say, approximately 1,000 crores? Would that be a safe number?
Safe number will be close to 1,000 plus, very safely we can say, from these order books.
Understood, sir. Thank you. That's all I had.
Thank you. The next question is from the line of Sunny from MK Ventures. Please.
Yeah, hi. Thanks for taking a repeat question. So basically what I wanted to understand is we have about, with the current expansion, about 400,000 tons of capacity between forgings and castings. So what would be basically the peak utilization or peak volumes that we can achieve out of the current capacity, and what is the peak revenue which can be generated from this capacity? And my second question is, as the earlier, like pre the inventory issue, our margins used to be 20 to 23%, but that had a specific business mix in terms of largely forgings. Now, with the business mix changing to castings and forgings and some B2C products which include assemblies, what is the new normalized margins we can assume when we reach reasonable level of capacity utilization?
So to answer your question one by one, I think in terms of at the peak utilization in terms of revenue, if we have the right product mix, which we presume in calendar year 27 by end, we should be having with the kind of order wins which we have had, we should be anywhere with the current capacity reach a revenue between 6,200 to 6,500 crores, depending on the commodity pricing, because commodity pricing is directly linked to the overall top line. In terms of margins, it is extremely safe to say that with the premix of casting and forging and with the kind of growth in terms of B2C axles and all, we may not be able to touch 20 to 23% because that was only for forgings. But in a premix of both the things, we are on the safer side, 17 to 18% margin going forward. Our aspirational growth still remains to go above 20 plus, but I think it will take some more quarters or year because kind of value add we are also introducing in the system. We are hoping that much ahead of our calculated time, we will be able to come to those margins also. But very safely, we can say that in a premix of casting and forging, 17 to 18% margin, we are going to get back to those figures very soon.
Sure. Thanks for the answer.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. Participants may press star and 1 to ask question. The next question is from the line of Saurabh from Sargi Capital. Please go ahead.
Hi, am I audible?
Yes, sir.
Yeah. So, sir, I think I understand that, Q2 had a lot of tariff-related disruptions. So, but you had guided that, based on Q1 call, that by Q4, the standalone margin might start getting back to the 20-odd level. Now, in the updated scheme of things, when do you see that those standalone margins of 20% coming up? Is it now Q1 or
No,
27?
In standalone, we still see that by Q4, basically, now we have two businesses, castings and forgings. Like in my previous answer, I said at a blended basis, we are looking at 17 to 18% margin. On a standalone basis at RKFL, we still are optimistic that we will be able to come back to those margins by last quarter or maybe by the first quarter.
Okay, sir. Thanks. Sir, another point is, so one of our listed peers, Bharat Forge said that, let's see, this entire North America thing seems to be right now too uncertain. But we are confident that, that we would be back on growth path. I think tariff was more of a disruption rather than demand disruptor. Is that a fair understanding?
No, I think tariff has nothing to do related with that. Tariff has disrupted demand also in North America. But at RKFL, because of our new order wins and new customer wins over there, we will be able to mitigate the demand destruction in our existing customer with the addition of new customers, wherein we will be able to pull back all those dollars which we are losing in our current customers because of the demand issue from the new customers.
Okay, fair enough, sir. Now, another question would be, are we, I think one of the focus area of the management has been to diversify away from both, auto as well as North America. Now, and Europe, you already talked about, you're making a steady headway. So, any color on, say, getting into defense or such kind of engineering, where I think offerings like ours have reasonable demand. So, any thoughts on that, sir?
We have actually, I think, reasonably done well in terms of our railway, and I think we are going to ride this passenger vehicle railway boom, and we are very focused right now in improving our railway output and improving our penetration within the railways. And I think that's a huge sector to bring in a lot of traction and new opportunities for us. In our opening call, our marketing head also has elaborated the kind of traction both in casting and in assemblies we have had from railways. And we believe that that is going to be a significant opportunity for us going into next year and year beyond that. So we would like to first encash that opportunity on a standalone basis, plus the wheel project which is going to come into production next year. We are looking at almost 40,000 wheels in FY27 coming from the joint venture. So obviously taken together, we are looking at a big uplift from railways itself into FY27. So I think our basket is full. We would like to first move one by one while we will keep on encashing this opportunity and grow in railways. Defense is also a likelihood going forward, but we are not immediately working anything big on defense to make investors aware. I think at the right opportunity time post we are done with railways in terms of our growth, we would like to focus on defense.
Thanks for the elaborate answer, sir. So for the, I think the railway wheels setup that we are that's coming up, say, and you're projecting around 40% wheels. So what's the revenue uptake that we would expect from that JV, and what are the margins? Would they be above RKF standalone or the blended 17-18%? What kind of margins that we are looking at the JV level? Of course, you have. I'm not looking at RKF share right now, but more JV. What's the top line and the bottom line?
So at 80%, 80-85% utilization, which we expect to have in FY28, we are looking at almost 16 to 1700 crores revenue from that operations, and that will be a 17 to 18% opportunity for us in terms of EBITDA margins.
And what kind of utilization you are expecting for
We are looking at
FY27, sir?
FY27, we are targeting only 40,000 wheels, which is going to be close to 30% of the utilization.
Okay, sir. No, okay, sir. Thanks for the opportunity and best wishes for the coming quarter, sir.
Thank you. As that was the last question for the day, I would now hand the conference over to the management for the closing comments. Over to you, sir.
Thank you. We would like to thank all the for taking out time to join our earnings call. We hope we have been able to answer and address all your queries. For any further information, kindly get in touch with us or with CDR India. On behalf of Ramkrishna Forgings Limited, we wish you all a good week ahead. We look forward to interacting again in the next quarter. Thank you very much for talking with us again. Thank you.
Thank you. On behalf of IIFL Capital Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.